Hello, traders. Gary Wagner with the Gold Forecast here on Thursday, the 9th day of December, approximately 9 o'clock here in Honolulu, Hawaii. And we have gold trading modestly higher, up about $4.50. $7 is a higher bid due to predominant buying, and strengthening US dollar is giving it a tug of about 250, therefore the net $4.50. Currently trading 1384, 1385. On today's report, we are going to talk about, do we think we have found some tentative support in this market? What is our interim look? And what is our next strategy? All here on today's daily report. Traders, we are currently looking at a daily chart of spot Forex gold, and the candlestick that we are getting right now is known as a inverted hammer. It's a shooting star, this candle right here, if it's found after a significant uptrend. If it's found after the market is sold off, of course, it is called an inverted hammer. Now, here's what I'm finding interesting, and that is that we had this first top. This is that 1388 top right in here. Market, of course, came down lower and came and completely broke that out, and this is what we were looking at as possibly forming that head and shoulders, this being the shoulder, this being the head here. It did come down. It formed a very, very strong base at 1330 right in this area, and then significantly just kind of broke right through there. Now, here's what I'm finding interesting, and that is this morning we are seeing the point in which we typically had resistance, which was right in here, has now become, at least tentatively, support. Traders, this of course is our daily Henkin or average chart, and what we are noticing with the Henkin chart, and realize that as a moving average indicator, it will typically and always lag behind that of the leading indicators as we spoke about yesterday. But what I am noticing is that we do have this prevalence right now of these lower tails. Of course, these lower tails, and also the shortening of the body length when you compare this Henkin candle to this Henkin candle, shows you that in terms of this downside pressure, it is actually at this point running out of steam. Again, as we look at this daily chart, this is another one of our daily charts that we use. I think that it quite eloquently illustrates this resistance here, at least tentatively, does look like it is now becoming support. Lastly, we're going to look at our 240-minute channel chart, and traders, you realize that we look at this to see if we can get any indication as to the range that it's trading in, and it gives us a much better sense or feel, I think, for how the market is operating. And right now you can see that each candle, of course, represents 4 hours in trading, but you can see this lower band right in here, and it does appear, at least tentative, that that upper band is this band right in here. So in terms of our averages, in terms of Fibonacci retracement level, and the reason I say averages is because these move as the market moves, but we've got the upper band at 38%, and this lower band is our 76%. And as I said, traders, realize that these numbers do move as the market moves, but I do believe that it can give us a really good sense or good indication. You saw that this low came down and touched that 0 point. Now, that 0 point, which is based upon this low here, of course, as you can see, has moved up, but at least tentative, it does look like it is on an upward track, and it is following in between these two channel lines. The one thing that I think we can see with some certainty is, at least tentatively, this large sell-off that we got right in here did end, and it looks like it ended right in this area right here where we had a doji and then the red candle, and then it began to move up. So traders, what are my recommendations? I think that this current sell-off, this pullback, is a good position for us to consider re-entering the market. Realize we got out at 13.95. We can take a small position in this marketplace today, about $10 less than that, so 13.85. My recommendation is therefore enter the market with a long position. You should be in at around 13.85, 13.86, somewhere in this area right in here is where you're going to enter. Now, in terms of a stop making sense, a conservative stop right now is going to have to be between these 2 points, but really should be below this one area here, which is 13.50. My recommendation is going to be enter the market from the long side. Your stop is going to be 13.45 on a protective stop. Traders, you can enter this as a long position. Now, one caveat on that. We are going to have a scenario this weekend where it has been rumored that the Chinese might in fact go ahead and have an interest rate hike. That would put pressure on gold prices, but that's being viewed really as something transitional and temporary in the overall price of gold. It is not the belief that that is going to drive prices down. Rather, if in fact it does happen, it might only put a little bit of pressure short term onto the market. Again, this is a more aggressive trade right now, traders, but we are working on the fact that we've gotten our pullback. We've absolutely found some support in this area, and we will take a look at what we see. I would say for conservative traders, put on a smaller position and look to dollar cost average if there is pressure that is created by a interest rate hike from the Chinese. This has been Gary Wagner wishing you, as always, good trading, and we'll talk to you tomorrow for the weekend review. Bye-bye.